Welcome to our comprehensive guide on funding and investment strategies for businesses. Whether you're a startup founder or managing an established company, understanding how to secure and manage funding is crucial for growth. In this video, we'll explore various funding sources, investment approaches, and practical tips to help your business thrive. Let's begin by understanding why funding is the lifeblood of any business and how the right investment strategy can make all the difference. Funding isn't just about having cash in the bank. It's about fueling innovation, supporting daily operations, and enabling expansion. Without adequate funding, even the best business ideas can struggle to survive. In this scene, we'll discuss how funding impacts every aspect of a business, from hiring talent to launching new products. Understanding the importance of funding helps you prioritize financial planning and make informed decisions for your company's future. Businesses have access to a variety of funding sources, each with its own advantages and challenges. Common types include equity financing, debt financing, grants, and crowdfunding. Equity financing involves selling shares to investors, while debt financing means borrowing money to be repaid with interest. Grants are non-repayable funds, often from governments or organizations, and crowdfunding leverages small contributions from many people. Choosing the right type depends on your business goals and risk tolerance. Equity financing is a popular option for startups and growing businesses. By offering ownership shares to investors, companies can raise significant capital without incurring debt. However, this means sharing future profits and decision-making power. Equity investors often bring valuable expertise and networks, which can accelerate growth. It's important to weigh the benefits of additional resources against the dilution of control when considering equity financing. Financing involves borrowing money that must be repaid over time, usually with interest. This method allows business owners to retain full control, but comes with the obligation of regular repayments. Common sources include bank loans, lines of credit, and bonds. Debt financing is best suited for businesses with predictable cash flow and a clear plan for repayment. It's essential to understand the terms and ensure your business can handle the financial commitment. Government grants can be a fantastic source of funding, especially for businesses in innovation, research, or social impact sectors. Unlike loans, grants do not require repayment, but they often come with strict eligibility criteria and reporting requirements. Applying for grants can be competitive, so it's important to tailor your application to the specific goals of the grant provider. Successful grant funding can provide a significant boost without adding financial burden. Crowdfunding has revolutionized how businesses raise money. By appealing to a large number of people online, companies can gather small investments that add up to substantial funding. Platforms like Kickstarter and Indiegogo make it easy to showcase your idea and attract supporters. Crowdfunding is especially effective for consumer products and creative projects. However, it requires strong marketing, a compelling story, and clear rewards for backers. Angel investors are individuals who provide capital to startups in exchange for equity or convertible debt. They often invest in early-stage companies with high growth potential. Beyond funding, angel investors can offer mentorship, industry connections, and strategic advice. Building relationships with angel investors can be a game changer for startups, but it's important to align on vision and expectations before accepting investment. Venture capital firms invest in businesses with high growth potential, typically in exchange for equity. These firms provide not only funding but also strategic guidance and access to networks. Venture capital is best suited for companies aiming for rapid expansion and willing to share ownership. The process can be competitive and demanding, with investors expecting significant returns and involvement in key decisions. Private equity involves investment from firms or funds that acquire significant stakes in established businesses. These investors often seek to improve operations, drive growth, and eventually sell the business for a profit. Private equity can provide large amounts of capital and expertise, but it usually means giving up some control. It's a suitable option for mature companies looking for transformation or expansion. Bank loans are a traditional and widely used funding source for businesses. They offer predictable repayment schedules and can be tailored to various needs, such as working capital or equipment purchases. However, securing a bank loan requires a strong credit history, collateral, and a solid business plan. Understanding the terms and interest rates is essential to ensure the loan supports your business goals without causing financial strain. Line of credit offers businesses flexible access to funds as needed, rather than a lump sum. This can be invaluable for managing cash flow fluctuations or unexpected expenses. Interest is only paid on the amount used, making it a cost-effective solution for short-term needs. However, lines of credit often require good credit and may have variable interest rates, so careful management is key. Trade credit allows businesses to purchase goods or services and pay the supplier at a later date. This form of short-term financing can help manage cash flow and build supplier relationships. Trade credit is often interest-free if paid within the agreed period, but late payments can damage credit ratings and supplier trust. It's important to use trade credit responsibly and maintain good communication with suppliers. Bootstrapping means funding your business using personal savings or revenue generated by the business itself. This approach allows you to retain full control and avoid debt or equity dilution. However, it can limit growth if resources are scarce. Bootstrapping works best for businesses with low startup costs or those that can quickly generate income. Discipline and careful budgeting are essential for success. Many entrepreneurs turn to family and friends for initial funding. This can be a quick and flexible way to raise capital, but it's important to treat these investments professionally. Clear agreements and open communication help avoid misunderstandings. While support from loved ones can be invaluable, mixing business with personal relationships requires sensitivity and transparency. Strategic partnerships involve collaborating with other businesses or organizations to access funding, resources, or expertise. These partnerships can open doors to new markets, technologies, or customer bases. Successful partnerships are built on mutual benefit and clear objectives. It's important to choose partners whose values and goals align with yours to ensure a productive relationship. Convertible notes are a hybrid funding instrument, combining features of debt and equity. They start as loans but can convert into equity at a later stage, often during a future funding round. This approach is popular with startups seeking early investment without immediate valuation discussions. Convertible notes offer flexibility for both founders and investors, but it's important to understand the terms and potential dilution. Avenue-based financing allows businesses to raise capital by agreeing to share a percentage of future revenues with investors. This method doesn't require giving up equity or fixed repayments, making it attractive for companies with steady sales. Payments adjust based on revenue, providing flexibility during slow periods. However, it can become expensive if revenues grow quickly, so careful forecasting is essential. Initial public offering, or IPO, is when a private company offers shares to the public for the first time. This can raise substantial capital and increase visibility, but it also brings regulatory requirements and public scrutiny. IPOs are typically pursued by larger established companies ready for significant growth. The process is complex and requires careful planning, but it can transform a business's future. Mergers and acquisitions (M&A) can be a strategic way to access funding, expand operations, or enter new markets. By merging with or acquiring another company, businesses can leverage combined resources and expertise. M&A deals are complex and require thorough due diligence, but they can create significant value when executed well. It's important to align on culture and strategy to ensure a smooth integration. Franchising offers a unique funding model where entrepreneurs use an established brand's business model in exchange for fees and royalties. Franchisees often receive support with financing, training, and marketing. This reduces risk and increases the chances of success. However, franchise agreements can be restrictive, so it's important to understand the terms and ensure the brand aligns with your goals. Supplier financing, also known as supply chain finance, helps businesses optimize cash flow by allowing suppliers to receive early payment. This can strengthen relationships and improve financial stability for both parties. Supplier financing solutions are often facilitated by banks or fintech companies. It's a win-win approach that can support growth and resilience across the supply chain. Invoice financing allows businesses to borrow money against outstanding invoices. This provides immediate cash flow without waiting for customers to pay. It's especially useful for companies with long payment cycles. While invoice financing can be a lifeline, it's important to consider fees and ensure your customers are reliable payers. Microloans are small, short-term loans designed to help startups and small businesses. They're often provided by nonprofit organizations or government programs. Microloans can be easier to obtain than traditional loans and are ideal for covering initial expenses or working capital. However, interest rates may be higher, so it's important to compare options and plan repayments carefully. Peer-to-peer lending connects businesses directly with individual investors through online platforms. This can offer more flexible terms and faster approval than traditional banks. However, interest rates and fees can vary widely. Peer-to-peer lending is best for businesses with strong credit and a clear repayment plan. Always review platform reputations and investor requirements before proceeding. Issuing corporate bonds allows businesses to raise funds from investors who purchase the bonds and receive regular interest payments. Bonds are typically used by larger companies with strong credit ratings. This method provides long-term capital without giving up ownership. However, it requires careful financial management to meet interest and principal payments on time. Retained earnings refer to profits that are reinvested in the business rather than distributed to shareholders. Using retained earnings for funding avoids debt and dilution, making it a sustainable way to finance growth. This strategy works best for profitable companies with stable cash flow. However, relying solely on retained earnings can limit the pace of expansion if profits are modest. Selecting the right funding and investment strategy depends on your business stage, goals, and risk tolerance. Startups may prioritize flexibility and speed, while established companies might seek stability and scale. It's important to assess your needs, research options, and consult with financial advisors. A well-chosen strategy can provide the resources needed for sustainable growth and long-term success. Every funding option carries risks, from interest rate fluctuations to loss of control. Effective risk management involves identifying potential challenges, diversifying funding sources, and maintaining financial discipline. Regularly reviewing your financial position and adjusting strategies as needed can help your business stay resilient in changing conditions. Strong relationships with investors are key to long-term success. Open communication, transparency, and regular updates help build trust and align interests. Investors can offer more than just capital; they often provide guidance, industry insights, and valuable connections. Fostering positive relationships can lead to ongoing support and new opportunities as your business grows. Effective financial planning is the foundation of any successful funding strategy. This includes budgeting, forecasting, and monitoring cash flow. Accurate financial projections help you determine how much funding you need and when. Regularly reviewing your financial plan ensures you stay on track and can adapt to changes in the business environment. Compelling pitch is essential for attracting investors. Clearly articulate your business model, market opportunity, and growth plan. Highlight what sets your business apart and how you'll use the funds. Practice your pitch, anticipate questions, and be prepared to discuss financials in detail. Confidence and clarity can make a lasting impression on potential investors. Due diligence is a thorough review conducted by investors before committing funds. This process examines your business's financial health, legal standing, and growth potential. Being prepared with accurate records and transparent information speeds up the process and builds investor confidence. Addressing any concerns early can help secure funding and establish a strong foundation for partnership. Negotiating funding terms is a critical step in the investment process. This includes valuation, ownership percentage, repayment schedules, and investor rights. Understanding your priorities and being willing to compromise can lead to a mutually beneficial agreement. It's wise to seek legal advice to ensure the terms protect your interests and support your business goals. After securing funding, it's important to monitor business performance and use funds as planned. Regularly track key metrics, compare actual results to projections, and adjust strategies as needed. Transparent reporting to investors builds trust and demonstrates accountability. Effective performance monitoring helps ensure your business stays on course for growth. With the right funding in place, scaling your business becomes achievable. This might involve expanding your team, entering new markets, or investing in technology. Strategic use of funds ensures sustainable growth and maximizes returns for both the business and its investors. Always align scaling efforts with your long-term vision and market opportunities. Exit strategy outlines how investors will eventually realize a return on their investment. Common exit options include selling the business, merging with another company, or going public. Planning your exit strategy early helps align interests and set clear expectations. A well-executed exit can provide significant rewards for founders and investors alike. Legal considerations play a vital role in funding and investment. This includes structuring agreements, protecting intellectual property, and complying with regulations. Working with experienced legal professionals ensures your business is protected and avoids costly mistakes. Staying informed about legal requirements helps you navigate the funding landscape with confidence. Different funding sources and investment structures can have significant tax implications. Understanding how funding affects your tax obligations helps you plan effectively and avoid surprises. Consulting with tax professionals ensures you maximize benefits and remain compliant. Proactive tax planning is an essential part of a successful funding strategy. Business environment is constantly evolving, and funding strategies must adapt accordingly. Economic shifts, market trends, and technological advancements can all impact funding options. Staying agile and open to new opportunities ensures your business remains competitive. Regularly reviewing and updating your funding strategy helps you navigate uncertainty and seize growth opportunities. Technology is transforming how businesses access and manage funding. Online platforms, financial software, and data analytics make it easier to connect with investors, track performance, and forecast needs. Embracing digital tools can streamline processes and provide valuable insights. Leveraging technology ensures your business stays ahead in a competitive landscape. Sustainable funding strategies focus on long-term stability and responsible growth. This means balancing short-term needs with future goals, diversifying funding sources, and considering environmental and social impacts. Sustainable funding attracts investors who value ethical practices and long-term returns. Building a resilient funding strategy supports your business's ongoing success. Let's look at a real-world example of a startup that successfully navigated funding challenges. By combining bootstrapping, angel investment, and crowdfunding, the company was able to launch its product and scale rapidly. Strategic use of funds, clear communication with investors, and disciplined financial management were key to their success. This case highlights the importance of a tailored, flexible funding approach. Many businesses make avoidable mistakes when seeking funding, such as underestimating capital needs, neglecting due diligence, or choosing the wrong partners. Learning from these pitfalls can save time and resources. Always conduct thorough research, seek professional advice, and plan for contingencies. Avoiding common mistakes increases your chances of securing the right funding and achieving your business goals. Conclusion: funding and investment strategies are vital for business growth and sustainability. By understanding your options, planning carefully, and building strong relationships, you can secure the resources needed to achieve your vision. Remember, the best strategy is one that aligns with your unique goals and adapts to changing circumstances. Take the next step by assessing your funding needs and exploring the strategies discussed in this video.